Hello everyone, and welcome to Trader's Insight. I've been reading a book lately called Options Trading: The Hidden Reality by Charles M. Caudle, and I've learned a lot from it actually. Of course, it was written many years ago, so the way in which options are discussed and the way he sets it up are different than how I'm used to now. But I think there's still some good insights in it which we can use and you could use in your everyday trading. So I wanted to take a look at the trade which he calls the Slingshot trade. And this is it set up. The idea behind it is that in a normal collar where we have a call and a put, so say the 28 call and 28 put, we're going to short the call, buy the put, and then hold the underlying. With the collar, the idea is that you want to cap your downside, but then you're going to sell the call to cap your upside, as you can see here. The only problem is that for a lot of people, if they're setting up collars, they would want to have a situation where the stock takes off and they can profit from that. So what Charles Caudle does is he looks at it from setting up a butterfly combined with a long call. I'm not going to go too much into specifics here. It has a lot to do with synthetics, and we'll get into that in a different video. But essentially, instead of selling a covered call and then buying a put to protect the downside, what he says is you can buy the put, own the stock, own 100 shares of stock, and then sell call credit spreads to lower your cost basis. So as you can see here, if you just buy the stock and you have the put, all you're doing is essentially creating a call. You can see that it has the same profit ratio as a call and it acts in the same way. But when you buy the credit spread, essentially what you're doing is you're selling the credit spread and then you're collecting the credit. And the credit, you can see, helps lower your cost basis. And it also doesn't have an unlimited cap. So when you sell the vertical call, you're going to see that your profits can go on to infinity. And what I've done here for the setup is you're owning the stock, 100 shares, you're buying the put, and then you're selling two call credit spreads. And the way it's going to work is if we're at the current price of $25.77 now, it's going to gain value as time goes forward. Max value is going to be first at this peak of around, what is that, $27, which is going to be the short strike of the vertical spread, and max loss without going to the downside is going to be at the long strike, which is going to be at 28. So you have two choices here. One, you could hope that at expiration you're right around here for the 27, and then if you're getting closer to 28, then you could just roll it to another month. There's a lot of different possibilities that you can work with. Let's say it goes up $3, and now you're at this kind of break-even point where you're around zero. Since it won't be at expiration, it'll be following this purple line, which means you'll have quite a bit of profit. So what you can do here is either roll this to the next month or roll it to a higher strike, and that will allow you to keep your cost basis low and increase your probability of actually making money on the stock, which is, at the end of the day, what we want to do. You'll find out more in detail below. I'll write out the exact setup for it and post some pictures as well too. Don't forget, if you like our videos, to subscribe to our YouTube page and to sign up for a mailing list. We got a brand new options course out, and I think you should really check it out. If you don't know anything about options, it's a great intro to basic options. It will take you from not knowing anything to making your first profitable trade. Thanks for watching this video, and I'll see you next time.